the classified balance sheet, where we take our old balance sheet and we break it down a little bit. We're going to break down assets into two categories: current assets and capital assets. Current assets being the ones that we can liquidate the quickest, and then we're going to break down liabilities into current liabilities and long-term liabilities. Current liabilities being things that we can pay off either in a year or within our operating cycle. Now, an operating cycle is the period of time in which you go from cash to cash. In other words, from the time I buy all of my supplies and materials, convert them into the good that I'm producing, sell the good, and get the cash back. So it's either a year or during the operating cycle. For the purpose of this example, we're going to just pretend that everything takes a year. So we're going to list current liabilities. We're going to list things that we're going to pay off in the next 12 months. So first, you start, of course, with your list of accounts. Now, some of these accounts are temporary accounts, only to be used in the income statement. I've separated those from the other accounts, which are permanent accounts, so I've italicized the permanent accounts. So those are the ones that we use in a balance sheet. And now we're simply going to create a balance sheet from our trial balance here. And to make things a little bit quicker, I'm simply going to copy and paste the relevant things into the relevant areas. So under current assets, I would of course start with cash. So I'm simply going to drag and drop this in here. So I've got cash. Next would be accounts receivable. So I would bring accounts receivable here. Next, I would have prepaid insurance. And then last, as far as a current asset, I would have supplies. So that's just for this particular example. There we go. And now I have a total for my current assets. Okay, so that should probably be right there. Now, capital assets. Again, I'm going to start in descending in order in which I can get rid of them the fastest. So here I would probably start with equipment. Next, I would probably have to include the fact that I have some equipment that it's been depreciated. So I got to bring that number in and put it against the number I already have. And now I should have a little formula here. I had set it up so that it would work automatically, but I'll just put it in manually. So of the $60,000 worth of equipment that I had, it's now only worth $59,000. My next piece of capital asset, I guess, would be my building, and my building is worth $150,000. Okay, just going to expand this cell so we can see $150,000. But it has also depreciated, so I have to factor that in. And again, I'm going to have a formula here that's going to account for the depreciation. So my building's just started to depreciate, and it's worth now $149,500. And the last thing I would list here in capital assets would be my land, okay, being the piece that would be the toughest to liquidate. So I'll put that there. So now I've got a total for, so I'm just adding these numbers here. So I've got a total for capital assets, and I've got a total for my current assets. Okay, so I've got distinguished separate totals for both, and this is my total for assets. Current liabilities now are the things that I'm going to pay off, let's say, this year. Okay, so I would start with, I have notes payable. Now a note payable is like a loan that's payable. Now as you're paying off a loan, you're paying it every month. So we've figured out that during this next year, we're going to end up paying $5,000 of this notes payable. At the end of the year, we're still going to owe $135,000. that 135 is definitely going to be a long-term liability. But the part that we're paying this year, the 5,000, that would be a current liability. So we're going to throw that in right here. We're also going to have accounts payable, of course, which is going to be short term. And we're going to have interest payable. Now this figure here should add all of these up, and it doesn't seem to be doing that, so let me just fix my formula here. So I'm adding all of those numbers up, and I'm getting 8750. So these are our current liabilities. Later we're going to be comparing our current liabilities versus our current assets. You never want to have too many liabilities and not enough assets. We're looking for at least a 1-to-1 ratio. Now it's a little bit more than 1-to-1, which is good because our current assets outweigh our current liabilities. More on this in another lesson. Now our long-term liabilities, as I stated, we only have one in this example, and that would be our notes payable. So we have that big thing to pay over the long haul. So now we see that our total liabilities are 143,750. We're also going to be comparing our total liabilities to our total assets, and we're going to be figuring out whether or not we're in good shape or not as far as that goes. The last figure we're going to take, of course, is for capital, which is for owner's equity, and we're going to drop that in somewhere around here. I'm just going to move this number here. And now we're going to add, of course, our owner's equity plus our liabilities. And what we're looking for is a balance, right? Thus the term balance sheet. So that is a short example of how you would create it. Now, I had laid it out so that this video wouldn't take forever. However, you would have to do it on your own, of course. You take this original list from your trial balance, and you would take only the accounts that you know are going to be long-term permanent accounts, and you would leave the temporary accounts there. Those are the accounts we use for our income statement.